Hello everyone, the rupee finally recovered a bit. Crude has been going higher, coming down. Dollar INR has been continuously going higher. We have been following this chart, but then rupee recovered a bit in the last 2-3 working days. Okay, rupee had weakened to an all-time high. We have seen this all-time high at 95.44, and then just yesterday rupee recovered and it came to as dollar low as 94.0607, and today it is back towards 94.4050. Okay, so some decent recovery in rupee, but then what lies ahead is what we have to look at. Okay, so we have been following this linear regression channel for a while, uptrend, continuous uptrend, and all the moving averages, all these moving averages are also going higher. Okay, and we have some kind of a double top formation here. The first top here when it went to 95.22, and the second top here when it had gone to 95.44 just 3-4 working days back. Okay, so we have some kind of a double top, and then it came down a bit, could not sustain, and now it is on the verge of going higher again. Okay, now obviously all the focus is on the Middle East. If crude prices come down, then rupee might recover, but if crude remains above 108, 110 and all to $1 for Brent, then obviously rupee will be under pressure. Okay, but bottom line, if you see this region, probably this region of 95.20, 95.40 could act as some kind of a short-term resistance. Okay, that region could act as a short-term resistance primarily because of the double top that has formed here. Okay, let me show you another chart where there are some other indicators as well. Okay, so if you look at the Bollinger Bands and some of the other indicators that we are following, okay, prices did reach an extreme at 95.20.40. Okay, so that kind of reinforces that 95.20.40 could be some kind of a short-term resistance. And obviously the bands had widened and now it is contracting a bit. So volatility is gradually reducing, but then the volatility has stabilized. So in this kind of a situation, what should a dollar exporter and an importer do? Okay, when it went above 95, obviously fantastic levels. We had come with a video last week that above 95 levels, dollar exporters should do forwards and options both. Okay, and obviously importers, we had recommended do more of options because we were expecting some kind of a cool off, and some kind of a cool off has happened in the last 2-3 days. Whether the cool off will continue and it go to 93, 93.50, that is anyone's guess. Everything depends on the Middle East. If crude prices cool off, then probably we might see some degree of more rupee gains, but obviously not major gains, some gains only. Okay, so dollar importers, I think at this point of time, you should continue doing forwards and a bit of vanilla options as well. Okay, the market is still nervous, still tentative, so you should keep your positions hedged. And we have seen in recent history that forward premiums are lower and the rupee weakening is higher. So you should do a decent amount of forwards and also do some degree of vanilla options to give you flexibility. Okay, now what is there for dollar exporters? Dollar exporters, you had a chance at 95. We told to hedge using forwards and options both at 95. So you can wait for a while and look above 95, 95.20 levels, the resistance zone, to restart using forwards. Okay, options can be used anytime. So you can look at those targets to restart using forward hedging. You can do options hedging right now itself. Okay, I want to show you something more as well. Okay, now that is on the option premium side. Okay, now what is this chart? We have plotted 4 option premiums. Okay, so you have, this is the 1 month, okay, the blue line, the red line is the 2 month, 3 month is the green, and 4 month is the yellow line. So this is the option premium cost, option cost for an at the money strike price. Okay, for 1 month, if my strike price is equal to the forward rate, then what is the option premium? For 2 months, if my strike price is equal to the forward rate, then what is the option premium? Okay, So we have been tracking this premium for a lot of time. Okay. So this premiums, if you see, were very high around end of March. Okay. And even till the first week of April, when the war was at its peak, crude prices were high, lot of uncertainty, the option premiums were very, very high, end of March till first week of April. But after that, if you look at after first week of April, the premiums had started coming down. Okay. All these option premiums had started coming down. And that is fantastic news. Option premium coming down is a direct benefit to us, because if we buy options, the cost is lower now. Okay. But now after coming down towards the third, fourth week of April, see how it has, gone sideways in the last 2 weeks. Okay. So since the third, fourth week of April till the first week of May, what we are now. So in the last 2 weeks or so, the option premiums have gone sideways. It is not reducing further. Okay. So that is a very clear-cut indication that options premiums will not go further down. Okay. So another very strong recommendation that options should be used to hedge for both exporters as well as importers. Earlier the premiums were very high. Now the premiums are low. So the cost is low. The cost to hedge is low. So as an instrument to hedge, options should be extensively used by both exporters as well as importers. Okay. So that is it from my side. Have a great weekend ahead.